I remember January 2019. My coworker walked into the break room waving a brokerage statement. His actively managed fund had returned 18% that year. He looked at my plain index fund and said, "Emily, why are you leaving money on the table?" I smiled and said nothing. I already knew what the next 10 years would show him. Today, I'll show you the 20-year math on index funds versus active management. Not opinions, actual numbers from actual studies that permanently settled this debate decades ago. You'll see why 92% of professional fund managers fail to beat a simple index fund over time, and what that means for your money starting right now. Most people assume paying a professional produces better results. It seems logical. Experts should beat amateurs. That assumption costs millions of people hundreds of thousands of dollars. The S&P Indices versus Active report tracks every actively managed U.S. equity fund each year. Their 20-year data ending in 2023 produced one staggering number. 92.2% of active large-cap funds failed to beat the S&P 500 over 20 years. 92 out of every 100 professional managers lost to a simple index fund. This isn't a bad year or a market fluke. The SPIVA report has tracked this for over 2 decades. Every year, in every category, active managers underperform the index over long horizons. The reason is one unavoidable mathematical reality: costs. Every actively managed fund charges fees. Those fees come directly out of your return before you see a single dollar of gain. The average active U.S. equity fund charges 1.2% annually. The average index fund charges 0.04. That gap sounds small. Over 20 years, it is catastrophic. Here's the math: $100,000 invested for 20 years. Both earn the market return of 10% before fees. Index fund investor nets 9.96% annually. Active fund nets 8.8%. Index fund after 20 years, $659,000. Active fund, $532,000. Fee gap, $127,000. Now let me show you 4 real people with incomes close to yours who made different decisions and ended up in very different financial positions 20 years later. First is Claudia. She's 34, earns $4,200, and manages projects in Seattle. In 2010, she placed her entire IRA into an actively managed fund her bank recommended. The fund had excellent 5-year performance when she bought it. By 2023, it had trailed the S&P 500 by 2.1% annually for 13 consecutive years. Claudia doesn't know this because she never compared it to a benchmark. The statement shows gains. It never shows what she could have had. That gap is invisible until you calculate it yourself. Now meet Jerome. He's 38, earns $4,900, and works in engineering in Austin. He spent 6 months researching which fund manager had the best track record before investing. He chose a 5-star Morningstar fund. Research from Morningstar itself in 2020 shows 5-star rated funds revert to average performance within 3 to 5 years in the majority of cases. Jerome's fund did exactly that. His research effort was real. But past performance has no reliable predictive value for future active fund returns. The data is unambiguous on this point. Then there's Patricia. She's 41, earns $5,100, and works in accounting in Ohio. She split evenly, half index, half active, thinking it was a prudent and balanced approach. After 15 years, she ran the numbers. The index fund half had grown 31% more than the active half on identical contributions. Balance had simply diluted her stronger returns. Finally, Stephen. He's 29, earns $4,000, and works in graphic design in Portland. He discovered index funds 2 years ago and set up automatic monthly contributions into VTI immediately. Stephen has the simplest portfolio of the 4 and will almost certainly have the best outcome at 65, not the smartest. He stopped trying to outsmart a market that always rewards simplicity. Our brains are wired to believe more effort and higher cost produce better outcomes. In almost every life domain, this is true. Investing is the rare exception where the opposite consistently holds. A UC Berkeley study from 2018 found investors overestimate expertise in active management. often paying for the feeling of professional oversight rather than for any measurable results. Active fund marketing amplifies this. Every ad shows the best period. No fund advertises its 20-year underperformance against an index. The environment is designed to make active feel rational. There is also the narrative fallacy. A skilled manager with a compelling strategy feels more trustworthy than an algorithm that buys the whole market and holds it forever. The algorithm wins anyway. It wins because it generates no excess costs, makes no emotional decisions, and has no career incentives that might occasionally conflict with your actual long-term financial interests. Here's the personal math. $300 monthly for 30 years. Index fund at 9.96% net. Final value $682,000. Let that number land. Active fund at 8.8% net. $521,000. Difference $161,000. The market worked identically. Fees decided who actually kept the gains. Step 1. Log into every retirement account and find the expense ratio of each fund you hold. It is in the fund details page. Write the numbers down. Flag anything above 0.2%. Step 2. Find the index fund options in each account. Every 401k offers at least one. Look for S&P 500 index or total market fund. The expense ratio should be below 0.1%. Step 3. For an IRA or brokerage, look at VTI, VOO, or FSKAX. These are broad index funds with expense ratios between 0.01 and 0.04%. Simple and effective. Step 4. Switch new contributions first. Selling everything triggers taxes. Redirect future contributions to index funds. Over 12 months, your allocation naturally shifts without taxable events. One question I always get: what about the managers who do beat the index? They exist. The problem is that you cannot identify them in advance with any reliability, only in hindsight. The S&P Persistence Scorecard shows top quartile funds have a 25% chance of staying top quartile the next 5 years. Exactly what random chance predicts. Nothing more than chance. Past outperformance does not predict future results. Tested across decades in many markets, the conclusion is always the same. Selecting winning active managers in advance is simply not possible. Now, the retirement picture. Index fund investor at 65 withdrawing 4% annually. The standard safe withdrawal rate receives $27,000 per year in passive income. Active fund investor at the same rate receives $20,800 per year, over $6,000 less annually in retirement, all from one fee decision made at age 35. I checked in with Daniel last year. His active fund returned 41% over 5 years. The S&P 500 returned 93% over the same period. He finally made the switch. His only regret was not doing it sooner. That is what I hear most from people who find this math late. Not anger, just the quiet wish they had known earlier. You know now. The math is settled. The decision is simple. The only thing between you and the better outcome is inertia. And inertia is something you can fix tonight before you go to sleep. If this gave you clarity, hit like. It helps reach the people still paying 1.2% in fees without realizing it, which right now is the majority of middle-class investors in America. Next on the channel, the exact 5-segment portfolio structure for someone earning $4,500 a month, built to survive crashes and grow through every market cycle that follows. One question for the comments. Do you know the expense ratio of your largest account right now? Write the number below, or write checking right now. I read every single response. Now, the most common objection I hear: what about Warren Buffett? He beats the market. Yes, he is also one of the most extraordinary investing minds in history across 7 decades. The question is never whether exceptional managers exist. The question is whether you can identify them before they outperform, and whether their fees still leave you ahead of a simple index fund. An AQR study from 2021 found that Berkshire's outperformance, adjusted for risk and leverage, largely disappears without needing any genuine stock-picking alpha from Buffett at all. For every Buffett, there are thousands of managers who delivered Buffett-level confidence while producing below-index returns at higher fees. The confidence was real. The alpha was not. Active management is structurally disadvantaged. All investors together own the entire market. For every manager who beats it, another must underperform by the same amount. It is pure arithmetic. This is arithmetic, not opinion. Active managers as a group cannot beat the market because they are the market. The only guaranteed winner in this zero-sum game before fees is the index fund investor. After fees, the math tilts further. The active manager charging 1.2% must beat the market by that margin every year, just to keep pace with an index fund investor paying nearly nothing. Sustained outperformance by that margin, year after year, over 20 years, has been achieved by fewer than 8 out of every 100 funds. The SPIVA data makes the precise count clear every year. Outperforming funds attract huge inflows. That new money makes the same returns harder. Outperformance is self-defeating at scale. Most investors arrive after the opportunity has already closed. A fund managing $200 million can move nimbly. The same manager running $20 billion cannot. The strategy that built the track record often collapses under the weight of its own success. This is capacity constraint, one of the most reliable patterns in fund research. The smaller the fund, the more room for alpha. Most investors arrive precisely when that room has already closed. By the time a fund tops a ranking or earns a 5-star rating, the conditions that produced it have often changed. You are buying yesterday's performance at tomorrow's inflated asset level. The index fund has no capacity constraint. VTI holds every publicly traded U.S. company proportionally. Its strategy cannot be crowded out because it owns everything. That edge never disappears. Index investing is not passive in the lazy sense. It is a deliberate choice built on decades of evidence that consistently beating the market after costs is not achievable for most investors. Choosing index funds is not giving up. It is applying the most rigorous finding in investment research to your own money. That is not passive thinking. That is the most informed decision available.